So thanks very much, everybody, for joining us for another Get in the Groove workshop. Today, just because Emma James doesn't need any more stress dealing with finances at the moment, she has kindly agreed to set aside much needed time for us and for her, on other things probably, to talk us through how to get ourselves set up to be in a good place next year to manage our finances. And as Emma said when I was talking to her about designing this workshop, the one thing that she's discovered through helping people through the last 9 months is that the people who really understand their cash flow and where their money is and how to manage their money are the ones that have been able to be less stressed and more flexible, and know how to get out of all this mess in the best possible way. There's obviously lots of stuff going on that we don't need to go into. But I think Emma's just going to give us some tips for how to get set up for the best possible way for the coming year. So Emma, thank you very, very much for this.
No
We know your time is really precious. So over to you, off you go.
Right, I'm going to share my screen because more for bullets for me, I think, than anything else. But let's see how this goes. Okay, can you all see something?
Yeah.
Awesome. Right, so as Anne was saying, this year has been quite difficult for a lot of businesses. There's been a lot of upheaval. Some people back in March lost all of their future work. Some had to change direction. Others just had to deal with increased demand. So it's not necessarily that everything went completely bad, just lots of things for everyone to have to deal with. And I would say that the vast majority of businesses that I've been dealing with have actually done fairly well. It's been very difficult for them, but they're all coming through. They're all coming through the other side. And I would say that the one thing they really do have in common, which is what prompted my comment to Anne, is that they all already had a really good sense of their numbers. So back in March, when everything all started, they were all able to just look at their tested tools and know what they could do. So what expenses they could drop, what they had in their pipeline that might not be there anymore. So I think knowing what's happening with your money is just so important. And it doesn't have to be scary. It's got very little to do with maths. And lots of people always say, oh, I'm not very good at maths. You don't have to be. Plenty of accountants aren't. It's more about knowing, I guess that the aim with all of this is knowing how money is coming into the business and where it's going, and ideally when all of that is happening. So we're going to have a look at what you want to have in your toolkit to help you make all the big decisions, not just while we're in a global crisis, but just generally. And these are really good things to know and to have in place just generally in business. It's quite informal. Feel free to interrupt, just pop a question in and Anne will interrupt me as necessary. So I'd say the first thing is you do have to be prepared. And as I was just saying, you don't hide from those numbers. I think particularly for sole traders, it is very, very tempting to only look at your stuff once a year when you come to do that tax return. Hopefully not in January, but maybe. And all you're really doing with this is creating more stress. And you're also potentially missing out on opportunities that you could be taking throughout the year. Because if you don't really have a good sense of particularly your expenses, but if you don't have a good sense of those, you can't, it's difficult for you to be able to say, oh, something's come up that needs a bit of extra money. Can I actually afford to do it? It doesn't need to take forever. I'd say for businesses of our sort of sizes, about an hour a week is plenty. And a lot of that is actually going to be on reviewing things and reviewing your costs, reviewing your pipeline. As I've said a few times about building that toolkit, and there are lots and lots of different ways that you can do that. So one thing to look at is bank accounts. So again, sole traders, you have got a huge market out there of different things that you can use, and there are lots of bank accounts. And when I say bank accounts, I'm including things like Coconut which isn't technically a bank, but they offer current accounts. So you've got things like Coconut, Tide, Starling. They are all bank accounts, but they are all really acting as software, bookkeeping software as well. Certainly with Coconut and Starling, you can use those to record your receipts. You can invoice through them. So I'd say for sole traders, if you're using one of the challenger banks, that's probably all you're going to need. I'm not entirely convinced about those banks for limited companies. I think if your limited company is very, very small and very, very straightforward, it's probably fine. I think once you start adding VAT into it, it all gets a little bit complicated. My pick out of all of the different challenger banks, if you're going to use it for bookkeeping software as well, is Starling, and add in the business toolkit that they do, which is about £7 a month, I think. As I say, I think for limited companies, you do need proper bookkeeping software for those, but for sole traders, they're perfectly fine. I do tend to push people towards some sort of bookkeeping software. Again, once you're a bit bigger, or you're a limited company, or you're VAT registered. I only use Xero because I think it's the best. You've got things like QuickBooks. I hate Free Agent with a passion, but it works really, really well for a lot of people, particularly particularly service-based businesses and consultants, that sort of thing. Free Agent works really well for. And I then couple that with some sort of receipt capture. So recording your documents. Most of us are probably going to be buying things mainly online. A lot of the bookkeeping software, those challenger banks, and you can also have standalone software like Receipt Bank. You can just forward those emails. So say you get an email from Adobe with your monthly subscription, forward that onto your software of choice. It then creates that that item in the software, and then you can just match it, or it will match itself against the money going out of the bank. And that's really what we want to do. So we're not having like the shoebox or the carrier bag or even the folder of documents once a year when you come to do the tax return. You want to be doing little and often, but I would say the main thing is to be automating as much of this data entry and the donkey work as you can. It's probably the most boring bit of the whole thing. So if you can just forward things on, or you can get apps where you can just take a picture on your phone. Back in the day when we could actually go out, if you went for a coffee somewhere, or you were getting the train, quick snap of the train ticket while you're on there, and then it goes just straight into the software and it matches everything up. So it's having everything in one place. So Louise talks a lot about the one source of truth, isn't she? And that's what we're after for the finance stuff, getting everything in there. What we also want to be looking at is, what does your pipeline look like?
Just before you move on to that, Emma, Jules has asked about using a personal but dedicated current account versus a business account.
I'm assuming, as you were talking about tax returns before, Jules, that you're sole trader.
Yeah, she says, yeah, for sole traders.
Point of view, that's absolutely fine. You might get into slight hot water with your bank, because it's often in the terms and conditions of the accounts that you can't use them for business purposes. But generally, you'll probably be fine and get away with it. I think the key thing is to have a separate account. So as long as it's separate from your personal account, that will be fine. A few different reasons for that. One, much neater to pull out all of your business expenses when you come to do your tax return. Two, if HMRC pick you up in their random spot checks to do an investigation, all they're looking at is the business expenses. If it's all mixed into one account, they're rifling through all your personal stuff as well, which is just going to make the whole thing take longer and also just means that they're going to see everything that you're spending your money on. And yeah, I think the third thing, if you've been a bit lax with your bookkeeping throughout the year, having things in a completely separate account means if you don't have receipts for things, then you can still see that those expenses happened. Whereas if it's all mixed into one account, it's going to be difficult, particularly with things like Amazon. It's going to be difficult for you to be able to tell whether that was personal cost or a business cost. Does that answer the question?
Yes.
Yeah.
Okay, good. So Faye, you said that you're terrible at doing this. Do you mean just generally keeping track of things, or logging in once a week and trying to do stuff?
Yeah, I guess I'm just not in the habit of doing it, so I just never do it. And then I have to spend a frantic few days doing it at the end of the year. So yeah, it's definitely something I need to get better at.
Okay.
This is putting you slightly on the spot a bit, Faye, a bit unfair. But why? Like, what specifically do you think? Do you think it is just habit? So you're just not in the habit of it, or is there anything specific that you think, oh God, I need to do this week, and you hate it, so you put it to one side?
I think it's just the habit, or not knowing that I had to do that at the start, and so I just haven't done it, if that makes sense. And then also I've got a Xero account, which is really good, but I just don't know how to use it properly. So I've got loads of things that aren't matched up, and it's a bit of a headache. So I'll log into it and I just think, oh, I can't deal with this, and I just yeah, that's really bad.
No, it's useful to know. Is that I just asked because if it was one particular thing, then I was kind of hoping I could say, oh yes, you can do this really easily. But yeah, I think a lot of it is habit.
Yeah, Emma, you do offer a sort of monitoring service for people, though, don't you? People are doing their own things and they're not sure they're doing it right. You can sort of look over their shoulder virtually and just make sure that what they're doing is right and reassure them, and so they crack on and do a bit more.
Yeah. So I do have that as like a regular thing, but I need to come up with a better name for it really. But I also do kind of like a power hour thing now, where because the support is a regular monthly expense, and a lot of people don't need that. So I offer this 1 hour call where I just swoop in, sort your life out basically, and then swoop out, and then you're not having to see me all the time.
Okay, that's good to know.
So I think the other thing is looking at as I was saying, pipeline. So again, back in March when everything kicked off, what I was doing with a lot of clients is looking at what they had planned. So what their future sales were looking like, what their conversations were like, and then starting to, I guess we took a fairly pessimistic view of how much of that was going to come off, and then using that to then help us decide about expenses. And that then leads us nicely into knowing your expenses, and more importantly, knowing the ones that are basically non-negotiable. So for things like me, I pay for software for my clients, and then that's bundled into the package that they pay me for. So my software, my Xero bill is quite chunky each month. If I can't pay that bill, I'm in serious trouble, because if you don't pay your Xero bill, Xero cut you off, and I would then have to explain to clients why they couldn't access their Xero account. So it's knowing which ones are vital to running your business, but also knowing just which ones are nice to haves, and I guess grading them. So I think some people might be used to grading your clients, maybe of ones that ideally you wouldn't work with, but looking at your expenses in a similar sort of way is quite good. So again, I know, like, I have a big software habit. I don't need some of it, but I like having it around. I know that if I had to I know that there are a few expenses that do make my life easier, but I could also cope without them if I had to make efficiencies. So knowing those, and I think again, if you're doing this regularly, ideally weekly, but certainly monthly, you can start seeing what's happening. If you're, I mean, we'll come on to cash flow and budgeting and stuff in a minute, but if you're looking at those expenses regularly, you're also seeing all of them. If you're looking at things once a year, it's quite easy for things to escape your notice and for you to not see that you're spending like 15 quid a month on Canva and you haven't picked it up in 3 years, or for example. If you're looking at it more regularly, you're seeing every single one of those expenses. And again, you're able to then make decisions based on that. Knowing all of these and having that regular review, I said before, helps you to be able to take advantage of opportunities, and you can be a bit more savvy about things. So one example of that might be deciding to become VAT registered way before you hit the threshold. So a few years ago, I decided to become VAT registered. I wasn't at the threshold at that point, but I did it because at the time, most of my clients were VAT registered. So it wasn't, other than cash flow, it wasn't going to have a huge impact on them. And I was paying out a lot of money each month on VAT because of that software habit. So I decided that it was beneficial for me to do that. I have a client who sells children's books. They are 0 rated for VAT, which means she doesn't have to collect VAT off customers, but she can reclaim the VAT she's paying out on everything. So that makes really good financial sense to do that. And again, if you're not monitoring all of these things, that's the sort of thing that you're going to be missing. And I've also seen in quite a few of the Facebook groups recently, as people are doing their tax returns, quite a few people are noticing that they've gone over that VAT threshold and they haven't registered. And if they've gone over quite some time ago, which some of them have, they're going to start getting in trouble. So again, regular reviewing, particularly as you head towards that threshold, but just in general, is really, really beneficial. Any questions on that before I carry on? No.
Anne-Marie?
Nope. Sorry, can you say again, I missed about the being 0 rated for VAT. So you're VAT registered?
No, so sorry, I have a client who sells children's books.
Yeah.
And that there's no VAT on children's books.
Oh, I see. Okay.
So although it made no difference to her prices at all. Right. She doesn't have to collect VAT. She doesn't have to charge VAT when she sells those books, but everything she buys that has VAT on it, she can then reclaim that VAT portion.
Okay,
so effectively reducing her expenses.
Okay, thank you.
And yeah, because it's children's books within subscription boxes. So she buys a few of the different things as well, which all have VAT on. So she's getting quite a nice chunky reclaim from HMRC every quarter.
Oh, okay, thank you.
And talking about the devil incarnate, HMRC, we've got taxes. The absolute main thing: do not spend all your money. It is not yours. That I could just leave it there. Really, don't spend all your money. Ideally, you would be taking this year's tax out of this year's cash flow. And what I mean by that is, again, let's just pick on sole traders because their tax year is the same for everyone. The tax year runs 6th of April through to the 5th of April. So the tax returns that are due and the tax itself that is due in January next year, that relates to work that you were invoicing for between the 6th of April 19 and the 5th of April 20, when COVID wasn't really a thing. If you were saving tax throughout that year, the chances are you're going to have enough to cover that tax bill come January. if you thought, oh, I'll start thinking about that tax once, like come January, when I'm doing the tax return, and then I'll put the money together at that point. If you're a business that's been hit quite heavily, there is a chance that you might not have all of that tax, and you've already incurred all of the tax last year. How your business is affected this year isn't having an impact on that tax due. So while there are certainly things that you can put in place, and HMRC have got something called time to pay, which means that you can put in place a payment plan. So I'm not trying to scare anyone, all is not lost. But if you're saving the tax out of that year's cash flow, you're going to be in a muck. It doesn't really matter what then happens the following year. You've got that tax set aside. There's also things called payments on account, which after you've done it the first time doesn't really have a massive impact going forward. But the first year you are caught by this, it is an absolute kicker, because you effectively have to pay double tax in that first year. So payments on account, what they are is HMRC, they want your money. They will say, we estimate that next year you're going to earn exactly the same, your profit's going to be exactly the same, and we want the same amount of tax. And we want 50% of that upfront in January, and then we want the other 50% in the July. So still in the year that it's being incurred, but it's not being based on that year's actual work. And then every January you're paying the balance or getting a refund. So if you were overpaying on your payments on account, when you come to do your tax return, you'll get a little bit of a refund. If your tax is higher, then you'll just pay that little balance. Do payments on account make sense? Because they are tricky. They are a horrible thing to try and get your head around. And as I say, every year after you've done it the first time, it's not making that much difference. But in that first year, you're basically having to do 2 lots of your tax, which a lot of people just don't think of. In terms of how much to put aside, because I'm guessing that's going to be a question in a minute, sole traders, if your profit is below 50,000 a year, I would say you want to be doing about 30% of your income. So 30% of sales, I mean by that. That will give you plenty, and should mean that you have a good bit of a buffer once you've paid the tax. That is covering your basic rate tax at 20%, and it's also covering your NI contributions. If you're earning, or if your profit is over 50,000, you probably want to be close to about saving half of your sales. But if you're a sole trader and your profit is over 50k, you probably want to be looking at becoming limited. Certainly from a tax point of view, there are lots of other things to think about, but from a tax point of view, it's going to be beneficial to consider becoming limited at that point. And then if you are a limited company, your corporation tax, so the tax that the company pays is 19% on profit. So I tend to suggest people save about 15 to 20% of sales. Again, that will give you a really good buffer. And then your personal, if you're doing a mix of salary and dividends, which most people do, you probably want to be putting aside about 5% of what you take out of the company. It's a bit back of the envelope, all of that, but it's a good start. But if you're keeping on top of all of your expenses, you can start doing more accurate projections every month. So every month when I look at mine every week, but when I come to look at my tax every month, I'm basing that on my exact profit so far that year. And then I can project what my tax is likely to be. Okay. Any questions on taxes?
Okay about that?
And so everyone is looking a bit shell-shocked. So. And it's not everyone's view, but I see having to pay more tax is actually quite a good thing, because it means that your business is growing. It's going well. If your tax bill goes up each year, then that means your business is growing each year as well.
But it is really, really important to know that as you go along, and not get surprised by it at the end of the year.
Yeah. So if you only look at things once a year, you don't know. You can kind of get it. You might have a bit of a sense of how things have gone, but if your memory is anything like mine, you won't remember what happened like a year ago. So you might think, oh, the last few months weren't great, so I probably haven't made as much profit this year. But then you've completely forgotten that the first part of that tax year, you had an absolute bumper quarter, which kind of covered up for the rest of the year, and then so your profit is then higher, and then you then owe more tax. And again, if you're not saving that throughout the year, it can be a bit of a surprise come January, and no one needs that after Christmas.
Could you just cover where to put the money, Emma? Because I know some people have a separate bank account to put their tax savings in, don't they?
Not tax savings, so yeah, I would suggest either a separate account, or if you're using one of the Challenger ones, so like Tide, or I don't think Coconut have one, but Tide or Starling allow you to put them into what they call little pots. So you can set aside, I don't know, like 500 quid a month or whatever for your tax. And when you then go to look at your bank balance in the app, it will deduct that. It won't show you that amount, so you can't just continue spending from it. So it's effectively another account, but it's all within the same wrapper. As with personal savings, the saving rates are abysmal at the minute, interest wise, but it is still worth, if you're limited, or even a sole trader, it's still worth having a look at business savings accounts. Yeah, the interest rates aren't great, but as some of the money is going to be in there for like a year, you might just get a little bit of extra income in there. So yeah, like if you're using, say, like my account is Starling, and their pots are really quite useful. If you're VAT registered as well, you can then have your tax, your VAT, and then even things like, we're going to have a look at cash flow, but things like annual expenses as well. So I have to be a member of a professional body, and I have to renew that every year, and it's a decent chunk of money. So I put that into a pot, so I'm saving towards it every month. So that come December, because everything has to be around this time of year for some reason, come December, I'm not suddenly having to worry about finding this massive amount of money. I've just been saving towards it through the year, and I just go into my pot, transfer it back into the current account, and then just send it off to them.
Okay.
So once you've done your the day-to-day bookkeeping, so recording all of your expenses, and getting all of the documents and things together, we can then start the fun bit, and we can start looking ahead, and forecasting stuff. So I mean, cash flow forecasting is just a bit of a fancy term for, I mean, it's a bit similar to like a budget, and all you're doing is seeing what might happen in the future and what you want to happen. So it gives you an idea of, like expected income and costs, those annual expenses that I was talking about, or the irregular ones. So you might have something that you pay for every 2 years, for example. And it, again, back in March, when we were looking at forecasting with clients, it was really useful to them to be able to see what the new costs, so when, I hate the word pivot, but when they were pivoting to online, or I had a client who do an in-person conference each year, and they took that virtual. And you might think that would greatly reduce their costs, but the online platform was actually more expensive than the venue was going to be. So even with catering and all the rest of it. So being able to see what effect those decisions that you're having to make is having in the future is really useful. If you took out either just a normal loan or one of the bounce back loans that the government put in place, that won't show up. If you're only looking at your profit and loss account, if you're using software to see how much profit you're making, if you're only looking at that, all that will show in that report is the interest bit. It won't show you the actual repayments each month, that they're not an expense of the business. So it's particularly important if you do have one of those loans, that you're forecasting for what's going to happen at the end of the 12 months. So you had 12 months interest free. What's going to happen at that point? And depending on how much you took out, again, that could be a good chunk each month. And it's just being aware of what's going to happen. And these are things that you've committed to. So you need to have the money there. And it's looking at what is going to happen and when it's all going to happen as well. I spoke before about are all of your expenses necessary? So again, in times of crisis, we need to be looking at what is vital, what's going to keep the business going, and what's going to help grow it back up. And looking at all of those necessary things, and also including in there your own personal income. So making sure that you pay yourself as well. So if you're a limited company, you're probably taking an actual salary on payroll. But if you're a sole trader, you might just be taking money, whatever's left at the end of the month. Whereas if you treat it more as a regular salary and get that in the cash flow forecast, you can start seeing what you need to do. So do you need to make more sales? Do you need to upsell to existing clients? Do you need to raise your prices? Can you do some cost cutting? And you get more of kind of like a holistic view of the whole thing. And it also means that you can start planning different scenarios. So at the minute, things are that there's still quite a bit of general financial uncertainty around. People are starting to, or have been, tightening their belts with what they've been buying. And we've also just got changing restrictions. The whole tier system, like people are going to be in and out of that, probably going to end up back in lockdown early next year. So you've got all these different, it's a very uncertain time. So once you've got all of this in place, you can then start looking at different scenarios. So again, going back to my client before with their in-person conference, that conference happens towards the end of the year. So the plan is to have that in person next year, because hopefully by then it will all be fine. But we are looking at different scenarios for if that isn't the case, and how different things might play out and what effect that's going to have on costs, but what effect that's also going to have bringing it back to all those different taxes. In terms of how you actually put one together, I think I might have shared it before, but I can drop a quite basic spreadsheet into the Slack group, if that would be helpful for people.
That would be great.
Spreadsheets are fine. Say for our sorts of businesses, it's going to give you a good start. If you really want to get snazzy with it and you're using bookkeeping software, then there are things. So I use Futurely, and they all begin with F for some reason. So there's Futurely, Fluidly, Float, Fathom. I don't know why F. And they're all really good, and they just take, with the spreadsheet, you have to be manually updating it. With all those different softwares, you just plug it into Xero or QuickBooks or whatever you're using, and they get quite clever actually, and they start projecting different things for you. So yeah, they're really good. They're not particularly cheap, but they are good. So once you've had a look at all of this, I've covered a bit of this already, but if you're not liking what you're seeing with the cash flow, or if you're starting to look throughout the year and your profit isn't doing what you want it to, or your costs are a little bit high, what can you do to change all of that? So I've mentioned increasing your prices. It's something that Anne mentions quite a lot. Put your prices up. So I do pay attention. And you can also do things like reviewing your payment terms. And that's not just how quickly you want customers to pay you, but also think about how they pay you as well. If you have retainer clients, get them onto something like Go Cardless, which collects direct debits every month automatically. So every month you know that you're just getting that money in. You don't have to do any chasing, it just comes in. Stripe also allow you to do subscriptions as well, similar sort of thing. Look at if you've got a bigger project, look at your invoicing schedules. So at the moment, you might wait until either the very end of the project or towards the end and then bill at that point. Look at doing upfront payment or breaking the project down into different milestones. So that might mean that you're sending invoices, if it's a 6-month project, like 12 times, like just for the different milestones. But it spreads out. What we're trying to do with this is smooth out that cash flow so that you've got a bit more of a regular income, rather than in April having 40 grand come in and then you don't have much until the following January. So trying to smooth it out a little. Chasing your outstanding invoices. When I first take clients on, I see quite often that they have got quite high numbers of invoices outstanding that they've never chased. Chasing payment is rubbish. It's just a fact. It's awful, horrible to do, but that is your money. You've done the work, you need to be paid for it. And that is going to have quite a big impact on your bank balance. But if you're not collecting that money in, it's actually having a negative effect on your taxes. Because particularly if you're not on the cash basis, so that will be if you're a limited company, or if you are a sole trader who does the tax return on the accruals basis, which is when things are incurred rather than when you receive the money, those sales have already been included in your tax calculation. So if you're not collecting the money for that, you're paying tax on something you don't have, which we definitely don't want to do. Again, there's all sorts of different software that you can use to do the chasing. If you're using any of the major bookkeeping software, so Xero, QuickBooks, I think Free Agent have one, you can set automatic reminders, and that's usually enough. But then you can also start adding, there's a really good piece of software called Chaser that acts as a person. So it looks like it's someone in your accounts team doing all of this chasing for you. And that separates you from the money conversation as well, which is quite nice. And again, I keep saying it because it is really one of the main things that trips a lot of businesses up. Review your costs all of the time, and also keep an eye on if you can get any discounts. So a lot of software will give you a discount for paying annually. It's normally about a month or two free. It works out at, which is quite a big discount for a number for different software, and particularly if you have a lot of the subscriptions. And again, if you've got that cash flow forecast in place, you know you've got that money once a year. You don't need to be paying for the privilege of being able to pay monthly. How are we doing for time, Anne? Have we got any questions? So I've got a few more slides.
Yeah. Okay. Any questions on that so far? No, all okay?
So that was all like the main bulk of what I wanted to cover. And I've got a few other little things that are just like extras. This gets a little bit deep at times. So if you don't follow some of these it's fine. I'm going to throw some equations at you in a minute as well, to give you a little bit of a homework to have a look at your numbers. So this is when everyone just leaves the call.
I'll chase them up.
So we're wanting to have a look. All of this that we're doing is to make sure that we have a healthy business, because that's what we want. We've got great businesses. We want to keep them going. And
the reason most businesses fail is because they run out of money.
Yes. Yes, it's got
number one reason.
Yeah, and I'll cover this with like good bank balance. It's lovely looking at a nice profit figure. You can be very profitable and have no money in the bank. As I was saying before, if you're not collecting the money from customers, if you've got too many outstanding invoices, you could go out of business while still making a good profit. So that profit is nice, but really it's just vanity. It's a vanity metric, really. You want cold hard cash. And yeah, as I'm saying, most businesses go out because they run out of that cash. Even very good businesses can just end up with no money at the end of it. So with all of this information, it depends on the business, the industry, everything else. But in general, what you're looking at with your revenue or your sales, you want that to grow year on year, ideally. With your expenses, you want them to be staying relatively flat, or certainly rising kind of in line with your sales. You don't, if your expenses are suddenly zooming up and your sales aren't keeping up, at some point you're going to have a problem because you're spending out too much more money than you're getting in. It's not, well, you do want a good bank balance. Now, I wouldn't suggest making decisions based on your bank balance. You want to be making decisions based on your cash flow forecast. Because if you've got, 20 grand in the bank now, and your rent is 15 grand, and you've got payroll of 10 grand next week, that's not great cash flow, even though you've got a good bank balance. But on the flip side, you still want to be keeping an eye on that, because you don't want to be cash poor. So again, you could be profitable, you could have quite a few assets, but if they're not liquid, if they're not actual cash, you could be coming into a problem. And yeah, like with liquidity, what I'm looking at here is, can you cover your liabilities? So can you pay that VAT bill? Can you repay the loan that you've taken out? If you're a director of a limited company and you've put quite a bit of money into the company, can you repay that director's loan back? So that's what we're looking at with to see if we have a healthy business. And none of this should be looked at in a vacuum. You don't just look at this like once and then go, oh yeah, like everything looks cracking, and then you leave it. You want to be monitoring this over time. And like little blips, so like if you have a bad month for sales, that's fine. If that's a series of 6 bad months, you need to be doing something about it. So it's seeing how things are going over time, and it's also looking, what works, what is good for your business, and it's also trying to get a sense of what is about average for the industry that you're in as well. So covered a bit. This is getting a little bit deep into what you should be having in that health check kit, but really you want all of your information to be complete, accurate, and current. So that's what I was saying, like do things weekly, do it monthly, making sure that you've got everything, all the information that you need. So this is why I start throwing formulas at you. So we're going to look at 2 main types. We're going to look at profitability, because we're all profit businesses here, aren't we? I can't see who else is on the call, but we want to make a profit, and we want to stay in business as well. So these 2 things will help you keep an eye on that and make sure that both of those things happen. So you might often hear people talking about, so this is going to get a bit jargony, but you might hear people talking about gross profit margin and operating profit margin. All gross profit is you take your sales and then you take off all the costs that you've had to incur to make those sales. So if you sell wooden tables, your costs of making those wooden tables are the wood, is the wood that goes into the table, things like nails, that sort of stuff. What it isn't is things like rent for your workshop or salaries for your apprentices. So it's things that can be directly traced to your sale. So if you run workshops, that will be your venue hire. For me, that is zero. Those costs, because I can trace them directly to a sale, directly to an invoice. And operating profit, or net profit, you might hear it called, is sales minus all of your costs. So like your rent, stationery, all sorts of stuff like that. And what we're wanting with these two numbers, we want these, the higher the better, basically. And we can also compare these within our industry. So a lot of industries, certainly the ones that have like trade magazines or professional bodies, that they produce different tables where you can start getting the sense of what good numbers might look like in your industry. There are some industries that will, just by their very nature, have poor margins. So restaurants, for example, they're well, both margins, their gross profit and their operating profit, are both just by nature very low, because they have a lot of costs. They have staff, their premises, all that sort of stuff. My industry, particularly for sole practitioners like me who tend not to have premises, the gross profit and operating profit margins are normally fairly high. I know mine is a bit lower than, certainly my gross profit margin is a bit lower than some others in the industry, because the software I have chosen is expensive. But I think it's worth it. So it's being able to take those numbers and say, actually, yes, I know mine's a little lower than someone else in my industry, but this is why, and I'm satisfied that that's acceptable to me. If your gross profit margin is great, but your operating one is not so good, that means that your costs need looking at. Because your costs are, your just general day-to-day costs are probably a bit high. So that tells you that you need to start looking at that. If those numbers are starting to come down and that they're falling, then that could be, again, that's something to investigate, because it could be down to things like increased costs. So again, if you've had to move everything online this year and you've had to pay out for a load of software that you've never used before, or it could be because you've needed to offer discounts for sales. So these shops probably aren't a great example because they've just gone out of business, but things like the Arcadia Group, for example, have been on like 25-30% off sales pretty much since March. So that is going to have an impact on their sales figures because they've been discounting too much. Have I lost anyone yet? No, great.
If anybody's got any doubts at all about not offering discounts, please come and talk to me, because I've got a fantastic example of why that doesn't work.
So yeah, this is a really geeky one, but I like running it with clients. So I thought I'd throw it in here. You're probably going to only really know these numbers if you're using bookkeeping software. I wouldn't really expect someone just keeping track of their income and expenses on a spreadsheet to know these. So if you don't, that's fine. If you do know them, you can run this very, very quick equation. For those of us who don't have stock, the main one you're going to want is that quick ratio, the one at the bottom. Because the only difference in the two of them is you take the stock out of the bottom one. And this is telling you how well you can cover your liabilities. You're looking for a number more than 2. And that basically means that you have got twice as many assets. So that could be cash in the bank. It could be invoices out with clients. You've got twice as many assets as you have liabilities. So things that you owe. So things like VAT, payments to suppliers, that sort of stuff. If you are at 1 or lower, well, certainly lower, you cannot cover your liabilities. So that is something that needs looking at pretty quickly. And at that point, I would also suggest that being very, very careful before you start thinking about taking on more debt. So before you start looking at loans and all the rest of it. So again, when the bounce back loans were first announced, some clients didn't go for them because they were around about that 1 figure. And while they're doing okay now, we had to make a decision at that point, well, actually, a loan probably isn't the best thing right now because you're going to struggle to pay the liabilities. And that could mean that the business ends up failing in the next few months. So it's about making all of those decisions. I'm not going to throw any more numbers at you, but I just thought that that those were quite, well, I find them interesting, but I like this sort of stuff. I thought they were quite helpful to give you just a really, really quick sense check of how your business is doing. That is all from me, Anne.
Okay.
So
fantastic.
You can all ask me everything.
Right. Do you want to stop sharing your screen then, Emma?
Yeah.
So any other questions for Emma, or just are there anything in particular that you're not sure about that you'd like to cover in another session, or that you'd like to ask Emma about in the Slack group or anything like that? Anything that's really, really bugging you about this? Susie?
For me, it's just understanding those equations you put in. I love all that, but for me, it's understanding things like the cost of sales. So I'm a web designer, so I've been thinking that the biggest cost is my time, surely, or is that wrong?
Yes, but you're so just trying to think how to word this.
Okay.
It is. So you are selling your time. Your time doesn't really have an expense. Certainly not one that you can put on your profit and loss account. So for that sort of thing, whilst you definitely want, when you're coming to look at pricing, you definitely want to be making sure that you're. Anne's going to hit me, like, I'm not suggesting hourly rate. That's not what I'm suggesting. But you want to be making sure that you're not effectively working for free when you're coming to do your pricing. So you want to be making sure that you are covering that. But in terms of your cost of sales for working out profit, for you, do you offer hosting as part of it all?
No.
Okay, so it could be things like if you're buying themes, for example, like a WordPress designer might buy themes, or it could be images, maybe it's all fonts that you're buying. Someone like you is probably going to have a fairly low cost of sales and a pretty high gross profit margin. I would say for your type of business, probably you might even be as high as like 95-96%. Whereas like someone who's running a shop or a cafe or something is going to be way, way, way lower than that. But yeah, just because your main cost is your time, and time doesn't go down as an expense, really, then your margins will be higher just by virtue of what you do. However, if you're buying time off someone, so if you're paying like a freelancer or an associate to help you, or staff to help you, their time is then an expense, and then that goes down. But or if are you a sole trader? or
Yes.
limited. Yeah. So as a sole trader, you're not paying yourself a salary. So your time doesn't really hit the profit. Although yes, when you're thinking of pricing, you definitely want to be making sure that you're not effectively paying to work.
Okay, cool.
Jules?
So related to that then, so the cost of software, so I was just trying to get my head around the software. So if I use software that I use to create the emails, for example, or create images in the email, so Canva, that could be a cost of sales, but Microsoft Office wouldn't be. That would be an
So I would say something like Canva, if you're using it just generally for lots of different things and lots of different clients, I would say that that's just a general cost.
Okay.
So if you're only buying Canva because you have this particular client that you need to do something for, or this project, it's a cost of sale. I would say for our sorts of businesses and our sizes, I definitely shouldn't say this, but it doesn't really matter where exactly you're coding them and how exactly you're categorizing them. Because for us, what we're really going to be looking at is that, certainly from a profit point of view, we're going to be looking at that bottom figure. We're going to be looking at that final net profit. If it's easy to split into, this is definitely for this project, then do. But yeah, I think for things like Canva, I would be tempted to have that in just a general admin expense with Microsoft Office, and using things like if you're buying an image to go into a particular client's email, that would be a cost of sale. Does that make sense? But I would say, try not to get too hung up on it, because the main thing really is to make sure you're recording all the expenses. How you then categorize them is
it's the difference between the external measurement and the internal one, isn't it? And what we're talking about here is just looking at the sort of health of your business. So it's not about whether you pay more tax or not. It's got nothing to do with that. It's about how long you can exist, and perhaps helping you to identify which are the most profitable parts of your business, so you can do more of those and drop the least profitable parts.
Thank you. Yeah, that's good.
Okay, so great. So Emma, thank you again. That was fantastic, as always. For anybody who's really stuck at any of this, we've got so much information from Emma in our Learning Hub. There's loads and loads and loads of workshops and talks and just so much information there that really helps with all this stuff. And of course, if you've got any specific questions, you can always ask Emma in Slack. However busy she is, she's always popping in there and making sure there's there's messages. So again, Emma, thank you very much. That was superb.